Spot trading is one of the most fundamental concepts in the world of finance, particularly in the trading of assets such as currencies, stocks, commodities, and cryptocurrencies. At its core, spot trading is the purchase or sale of a financial instrument for instant delivery and settlement, meaning the transaction is completed on the spot. Imagine visiting a local market. You pay cash and take your goods home right away. Spot trading works on a similar principle, but in financial markets. Traders make deals at the current market price, known as the spot price, and the exchange of the asset, whether it's dollars for euros or Bitcoin for dollars, happens immediately or at most within a couple of business days. In contrast to spot trading, other forms of trading like futures or options involve contracts to buy or sell at a predetermined price at a future date, rather than immediately. This distinction is crucial, as it means spot traders are exposed to the current volatility of the market, with gains or losses realized in real time as the market price moves. Spot trading is popular for its simplicity. There are no complex contracts, no expiration dates, and generally lower risks of substantial losses compared to leveraging through derivatives. Traders can use spot trading to quickly capitalize on short-term price movements, to convert one asset to another, or to hedge their portfolios against sudden changes in market conditions. Liquidity is a key feature of spot markets, meaning there are usually plenty of buyers and sellers, which makes entering and exiting trades straightforward at transparent prices. Whether trading currencies, the world's largest spot market is Forex, stocks on an exchange, or digital assets on a crypto platform, liquidity ensures competitive pricing and smoother transactions. However, spot trading isn't without risks. Market prices can swing rapidly, especially in volatile markets like cryptocurrencies. This can lead to quick gains, but also sudden losses. Traders must keep a close eye on market trends, news, and events that can influence prices. Additionally, spot trading requires full payment upfront. There is no borrowing or margin here, so traders are limited to what they can afford at the moment. Understanding spot trading provides a strong foundation for anyone looking to enter financial markets. Its transparency, immediacy, and simplicity make it ideal for newcomers and a practical tool for seasoned traders. Whether you're seeking to diversify your investments, hedge risks, or profit from immediate price changes, spot trading is a powerful avenue to explore.